appropriate?
We are at a restrictive stance, in my view.
We're at a very restrictive stance on policy.
And intend to hold policy at a restrictive level. The process still has a long way to go.
Okay, so yeah, we're talking about the Fed here, right? We're looking at the video, and that process is starting to make its way through to the market, and I think it's hitting China pretty hard. So let's take a look at what just happened in China. Okay, first off, Hong Kong got hit pretty hard. Not Hong Kong, I'm sorry. The stock exchange over at China got hit pretty hard. So let me see, where is the slide? All right, so here we are. We're on the Twitter, right? Basically, what you got today was the Chinese real estate Evergrande, right? Actually, Evergrande is let me show you guys what Evergrande is. It is, first of all, what you want to know is that, you know, China, a third of their economy is driven by real estate. So a third of their economy driven by real estate, right? Now, Evergrande, they have, they caused the stock market crash for China back in 2021, I believe, or 2022 early. So they caused the global recession. You know, they had a lot of losses, and basically those losses have finally became realized, right? And they dropped 90% last night. The problem is it didn't just drop in one day. This had been over a period of time. So what we're seeing basically for China is those high rates in the US are starting to hit China. Okay, they're starting to hit China. And now you have stimulus, right? Now you're getting stimulus coming. Now, I've been saying this for a while. We're going to see China start to stimulate. And what they did is they basically cut the stamp tax rate, right? And they cut it by 50%. And what it is basically a trading tax rate. And what they're trying to do is stimulate their markets, right? They're trying to stimulate markets and their economy at the same time. And they're going to have to keep doing this. With these rates so high, they're going to have to keep doing this. China's going to have to keep boosting whatever they can because rates are just too high globally. And so I'm trying to find where. So basically, they got the China tax stamp, right, for trading. And they also relaxed the mortgage loan demand, right? They also relax that. And what is that? Chinese central bank announces guidance on relaxing residential housing loan rules in a move aimed to boost loan applications. And what they basically did here is if you're a first-time home buyer in China, you get incentives, right? You're going to get incentives. But if you're not a first-time home buyer, you don't really get those incentives. So they just basically said if you've already have a mortgage or you've already paid off a mortgage, you also get those incentives. So they're trying to boost applications. They're trying to boost housing purchases. Because as we said, right, for their economy, not unlike ours, a third of their economy is real estate, right? So they're trying to stimulate the markets. They're trying to stimulate, they're actually trying to stimulate the housing market again. So yes, Evergrande crashed, and it's been crashing for a while. This is not new news, right? This is not news, but they finally released some of their earnings, and they're down like I think they lost like 4 billion. And they opened up the markets for Evergrande. So first-time home buyers incentives, non-first-time home buyers are starting to get that stimulus now. They also cut that tax. And what I want you guys to want to emphasize here is that weakening economies, right? We're starting to see global economies weaken, and weak economies globally lead to more stimulus, either rate cuts or liquidity injections. And they're cutting rates, right? They're cutting basically the mortgage. The housing market, for the stimulus for the housing market, they're kind of cutting rates. They're increasing liquidity. They're allowing more people to actually purchase, and then to get a better deal for their real estate market. And when it comes to trading, they're lowering the tax for trading. Okay, so they're stimulating. They are stimulating in some degree. That's what China is trying to do. Now, to look out further, right? Not this one. To look out a little further, what is the next data we want to see for China? So I'm going to show you guys here. Right, the next data to see if they're starting to recover is going to be Wednesday. Wednesday, we have their economic activity. I'm going to scroll to it. Economic activity on Wednesday. Come on. There we go. All right. So here it is, their manufacturing PMI. This is what we want to see on Wednesday. And this is until Wednesday, so we still have some time there. But the market's going to be looking forward to see, can they recover, right? Are they recovering? Now, this is lagging data, so this isn't going to be like immediately. But do their markets turn over following this data, or do they turn up? And you got the manufacturing PMI, right? So their purchasing managers index, or their manufacturing surveys to see if they're actually, if they're going to really roll back into a deep recession. I know we hear China's going into a deep recession. That's not necessarily the case. They recovered, but they're not recovering as strong as we thought they would, right? This is their service index. Their service index has actually been pretty strong, but is now plunging back to the 50 percentile, right? Once you get under 50, you're back into recession territory. So there's not a whole lot of buying happening over in China when it comes to their economy, because your economy is based off total spending. So they need to stimulate demand, right? And that is the question. Now, the next part here I wanted to point out is, as you do get to this, I got to get used to doing this. As you do get to, economy starting to decelerate, you do get more stimulus. And when I take a look at the global, I got a chart we're going to look at right here. When you look at the global central banks, right? Global central banks, where is that chart at? You see, and I'm going to get on here, we're going to see that global central banks are starting to actually weaken here. Or I'm sorry, they're starting to switch. They're starting to actually cut rates, right? So when global economies weaken, you get liquidity coming into markets, or you get liquidity coming into their economies, whether it's government stimulus, whether it's monetary policy, where the Fed or the central banks, whoever they are, the ECB, the Public Bank of China, they either cut rates, right? The government stimulates, or they start spending to boost the economy, infrastructure, real estate, whatever it is. Or you also can get debasement of currency. And I think that's what's happening with China. They don't want to debase their currency, because if they weaken the yuan, they weaken global trade. So we have actually, the U.S. has a trade, one of our officials is over there in China today talking about global trade and how to boost that. As long as our dollar strengthens, the weaker that China becomes, the weaker that the global economy has actually become. And I'm wondering, is that what the Fed's trying to do? They're actually trying to hike rates to weaken the global economy, to keep strength, to keep global strength in the dollar, because the dollar goes up, it crushes everybody else, including our assets at times. That can change at times. So going back to this chart, let's take a look here. I wanted you guys to see this. All right, so here we go. So this is basically what we're seeing is 22% of central banks, right? 22.7% of the world's central banks, mostly emerging markets, Vietnam, Sri Lanka, Brazil, Chile, are cutting rates, right? They're cutting rates, indicating we're at the end of the global tightening cycle. Okay, are we there yet? No, but this is an indication. This swing higher is telling you a quarter of central banks are starting to flip. They're starting to turn. The U.S. is going to make a big deal. After the Jackson Hole meeting, right? The Jackson Hole conference, which was the biggest, central bank conference during the year. You could dissect that a couple ways. I think it was a mix of dovish and hawkishness, right? But we are seeing is that other central banks are starting to ease, right? So we're getting that global move to rate cuts, and this is a big signal, because what it tells you is, you might be looking at recession happening in some areas, but a lot of areas already went through the recession. They're starting to cut rates. China will start stimulating. China will start cutting rates, and we're actually seeing global liquidity pick up, especially in the U.S. here, at least for the last 2 days, just because bond yields actually eased, which is usually not the case. So we did have bond yields ease. Now, talking about the actual Fed, right? When we go to the Fed and we're talking about what the Fed's going to do next, and we're going to get to the technicals here. We will get to the technicals, but looking at what the Fed's going to do next. Okay, so we know that China is going to have to start stimulating. We know that that they're going to cut rates. We know that they're going to have to do something to their economy, and we know that global central banks around the world are actually doing the same thing. They're starting to stimulate. So what we need to do is say, okay, is the Fed going to pause here? If the Fed pauses here, they're basically giving the move, or they're going to forecast. They're going to give the market room to interpret a pause. So what's going to get the market actually pause, right? Or get the Fed to pause for the market. And currently, S&P is bouncing. Okay, just real quick, we're going to come back to the technicals. The S&P is starting to bounce here. And we're seeing, we got that big hammer, right? That big hammer candle off the 438 support. And we moved up, we gapped up. We did have 2 days in a row, S&P up, and we did pull back before Jackson Hole. We bounced. So following Jackson Hole, a couple things did change, but what we're looking for is how are those jobs, because Powell did say that he's worried about, he's concerned with the jobs market. Is it easing? Is labor coming in to balance with the supply of labor? And that's the most important chart that we're going to look at for tomorrow, right? Coming into tomorrow. And so the Fed wants to see the supply of jobs decline, okay, right here. They want to see the supply of jobs decline. In other words, they want to see less supply of jobs, okay? They want to see this number tick lower. And I believe there it goes. So the estimate for tomorrow is 9.5 million jobs. That's the estimate, okay? The previous month was 9.5. So we need to be below 9.5. If we tick higher, the market's probably going to price in another hike, right? It doesn't mean it's going to go into effect. It just means that it prices in the hike. We don't get the hike till September 20th, but it's going to start pricing in a hike. So price action might be weak on the S&P side. And you might get bonds actually fall further and rates go higher if we get a bad report. So good news is actually bad news when it comes to the job openings report. You want less job openings. You want people to come and fill those jobs. And the primary reason for that is, you need people to fill. So there's two ways this goes lower. People come in and fill these jobs, right? That's the positive. That's the good part of it. They fill the job. So therefore you don't really need as many openings. The openings don't exist anymore because they're getting filled. Or companies are actually struggling and they're removing those jobs. Look at who is it that we saw? Some of the retail companies, right? They're pulling back. They're making big losses, so they're pulling back a little bit. So if they're closing jobs, that also is good. You're getting that balance, right? And this is to prevent a wage price spiral. That's exactly what it is, to prevent a wage price spiral. So these numbers are going to be important tomorrow for the Fed to weigh in whether they hike or pause on the 20th. Okay, this isn't the only factor. This is just one of the factors. The next big factor here, okay, which this is a factor. I don't know if this is actually going to slow. Okay, so this is U.S. home prices. This is the U.S. home price index, single family house prices, right? This is not inflation. This is not the rate of inflation. The rate of inflation is coming down pretty quickly when it comes to single family homes. This is the actual price. Prices always go up typically, right? But what we did see is from June of 2022 all the way through January of 2023, we saw home prices actually stall when it comes to the single family homes, right? And then it started going back up, right, after January. And this is one of the big reasons we're still getting hikes, or hikes still came into the system, because this inflation, this is just not good. This is pushing up bond yields at the same time, or bond yields could be pushing this up, right? It's tricky. Who comes first, the chicken or the egg? Now, on another way of looking at it, right, it's a little more clear. You see the big upside move in January. The average price was $392,000. February, March, April. Now we're in May, right? Well, this reading was from May, so it's backward looking data. Hopefully it becomes better. That's the whole thing here, is it is backwards looking, so it could be better, right? We don't know. 404,000 average home price. So those are the two data points that the Fed's going to be looking at here. Is, job openings tomorrow. What are the job openings? We want them lower. We want to beat the estimate lower. And then also, what does that home price index look like? We know the Case-Shiller data, which we could look at in a second. We know the Case-Shiller data, which is the home price inflation, is falling. It's actually negative. So home price inflation, or we're seeing disinflation, where home prices are actually falling and on a certain measurement. Okay, rents are, and most of it is coming from rent, but actually home prices, because there's a lack of supply, is pushing up prices in other areas. So it is very tricky. And when it comes to the economy, we don't really know what's going to happen. But when it comes to the stock market, the market's going to look forward. It just wants to see progress. It wants to see more disinflation on that front. Okay, it wants to see more disinflation on that front. So next segment, let's go ahead and look at the charts actually here. All right, let's look at the charts and see what we got going here, because we do have, let's see. Yeah, we do have the S&P starting to bounce here. And there's a couple reasons. I don't know exactly, we don't know exactly what the reason is, but we do have this, look, this reverse head and shoulders that we were forming, right? You could call it double head, double shoulder there. Here's the shoulder, right? But we're not slipping any further down. We're not coming any further down. Actually, let me put this on the full screen so you can see this better. So the S&P is holding on here so far. The S&P is holding on here so far. And one of the big questions is, why is it holding on here? And I think it's because liquidity is not falling anymore. Liquidity is definitely not falling anymore. You see that the RSI is starting to come up. And when I say liquidity, I'm talking about the US Treasury market. Okay. We know some of the negative factors to the market are bond yields. And last week we got 2-year bonds surging to the highs, right? If this breaks out, not good, right? It's going to push the dollar higher, rate of interest goes higher, and it's going to pull valuations down in the S&P because they're valued off, the S&P valuations are based off future interest rates also, right? And if the future interest rates, you go to 5-year, the 10-year, if they keep going up, then valuations have to reprice themselves lower, which means price is going to come down. Right. We don't know that though. The market could see GDP up, which we've been seeing, and more liquidity and still go higher. Right. That's not necessarily the case. It's always tracking the data and seeing what the market's actually reacting to. So for the most part, this is the 10-year treasury. And if you're bullish, you want to see this come back down, right? The higher it goes, the more shorts are actually piling in to short the bond market. That's what we've been seeing is a shorting of the bond market. If you see the RSI, we are getting some bearish divergence. What does that look like? Well, you have price climbing higher, but you have the RSI flat. That is bearish divergence, which means the shorts on the bond market, right? The 10-year, the people who are shorting the bond market, they might be covering here. And what is one signal? Well, maybe it's China, right? Evergrande actually falling apart there. Chinese real estate struggling. They could now start to cover their positions. Does that really affect the US? I don't know. Maybe it does. Maybe it doesn't. Either way, we're seeing that price action slow down. Could go higher from there, right? Now, bonds, looking at the bond market, you actually want the bond market to bid up so that rates can fall a little bit. And they're sideways. They had that bounce. We called the bullish divergence here. It did move up. So we saw bonds, long-term bonds go higher, and now they're stalled. We go to the dollar, right? The dollar is still breaking out at this point. So this is a risk-off signal. The dollar's still breaking out here. It is showing some... it was showing some bearish divergence, but it made a move higher. We are overbought on the dollar though. And if it does keep rising, I expect more risk off in the S&P, possibly breaking that head and shoulders pattern to the downside. But, you know, there's another way to look at this when it comes to the dollar. You could be just seeing, and it's always a could, right? We don't know. We're watching the price action. We're putting all the variables together. But we could just be rolling into this previous resistance level, right? Which was about 104. I still rather want to see it under 103 because that is the long-term resistance here. But maybe we're just coming into 104 before we go lower. You need those bond yields to really come down, okay? So yeah, going over to crude oil, right? As long as it stays sideways, inflation expectations don't really move when it comes to the energy market, right? Oil is the biggest input to inflation. And I know, you know, the Fed is focused on core. So this has had nothing to do with core, but it does bring down inflation expectations if it doesn't get above 83.50. We've been watching this level for 6 months now, 7 months. So we're going into 8 months of data and we cannot get above 83.50. To me, that signals that oil should be lower from here, especially with China struggling, right? Especially with global, when you get global economies starting to cut rates, they're not cutting rates for fun. They're cutting rates because they're slowing a lot and inflation is coming down. And we are getting more demand coming online, right? You have Iran. There's like 5 different countries who are actually increasing their supply of oil, plus the US. So that could bring these oil prices lower, right? Now, look at the VIX. Big signal here. The VIX is not responding. The VIX is lower following Jackson Hole. This is key here. Following Jackson Hole, right? Following, the big Fed meeting, following Friday's price action, you have the VIX coming down. So if the VIX is coming down, what does that tell you? That tells you that people are not really, I think they're waiting for this bounce in the S&P. Also, a big signal when it comes to volatility is the bond market. The bond market volatility is also coming down. And we're going to see why that might be the case, right? We know 10-year yields are backing off a bit. Hopefully they roll over. So 10-year yields are starting to back off a little bit. And that market volatility from the bond market, right? Volatility is coming down. So more confidence, less fear inside that market. And then we have the S&P obviously starting to bounce here, right? We're getting that bounce. Now check this out. Fed net liquidity is actually been moving higher. So I'm going to take the volume off so we don't have to see that. So this is Fed net liquidity. And Fed net liquidity is, there's so many ways to measure liquidity, but you are getting liquidity pour in here. And I think it's coming from the banking crisis, right? Those reserves, banks are collecting more liquidity if they don't have, if they're missing liquidity, they're getting it from the bank term funding program. So the more they get from the bank term funding program, the more support they actually have. And I think this could be, a reason why the U.S. Treasury market is starting to ease a little bit, right? They could be easing for that reason. Bukowski, what up, man? How you doing? So market liquidity is turning up. Now, another chart that shows us that is right here, right? I'm going to zoom into this a little bit. Here we go. So this is overnight reverse repo. So the RRP, this is money at the Fed in yellow, right? In that yellow. And we did bottom. So that money was leaving the market, and it bottomed out over in January of 2023, right? Which was around the same time that the market really started to break the bear market trend and move higher. So that liquidity moved up. Now, we talked about this week that maybe this liquidity slows down, but it looks like it keeps leaving the Fed. As it goes up, it's actually leaving the Fed, right? This money is leaving the Federal Reserve. It is, you could call it a cushion for capital markets, and that cushion is starting to increase. It's starting to come back in. Well, the cushion is decreasing at the Fed and it's coming back into capital markets, whether they're buying U.S. Treasuries, right, or whether it's going into equities. We don't know that. We can't tell, but we do see the Fed net liquidity is happening, right? And then in red, you have Fed excess reserves of deposit. Let's just call it deposits at institutions. So institutions are getting more deposits also. Their reserves are also rising. So I think global liquidity is picking up again, following China, following the Fed meeting, following Chinese weakness. You're getting liquidity tick up a little bit, right? It's not a trend yet, right? It's still low, but it is picking up a little bit. And if that's the case, this could boost the market. This could keep, Bitcoin, Ethereum, stocks, NASDAQ higher for now, as long as those U.S. Treasury yields or the bond market doesn't fall apart. So we need resistance here. We need the U.S. 10-year to be resisted so that the bond market, so that the collateral at the banks doesn't fall apart. Now, if the banks are struggling, right, they just pull from the BTFP, which was created back in March. And if that's the case, you just don't get liquidity fall apart. So that's kind of the bullish side of things is, yes, Evergrande falling apart and has been falling apart, but Chinese weakness actually comes out to more liquidity. It comes out to more Fed liquidity. And that's why I think you see markets responding by actually holding up here at these levels. So I know a lot of bears are expecting that rollover, but we're not seeing a rollover, right? That's just not happening here. And you have 25 or a quarter of central banks. You have a quarter of the central banks in the world, global central banks, starting to cut rates. Now, another, let me see, okay, here it is. So another fear mongering chart that people point out is that when the Fed cuts rates, right, that markets actually roll over. But I'm going to show you something different here. When the Fed actually cut rates the last 2 times. So let's check those charts out really quick. So this was back, and we're going to get to the actual intraday fundamentals here, the intraday price action here. All right. So in 2019, in blue, the Fed started to pause. That's a sideways action, right? You can see there that the line is sideways. That was the Fed pause. They were increasing rates, and then they paused right here. When they did pause, that coincided with the market actually bottoming. I remember that. I was holding Facebook at the time. It was December. I was visiting, and I remember the Fed came out on Christmas and basically said, hey, we're actually going to stop raising rates. We're going to go on pause. The market recovered. It went back to all-time highs, okay? Once they started to cut rates, once the market started to cut, or the Fed started cutting rates, the market went past all-time highs. It broke out. Now, it wasn't straight up, but it did trend higher to all-time highs. And now people are telling you that when the Fed cuts rates, the market dumps. There's a bunch of reasons the market dumps. It's not because the Fed cuts rates, especially if you're coming from the lows. If you're at the highs and they cut rates, that's different, right? If the market is nearing all-time highs and then the Fed has to cut rates because there's some type of growth or there's some type of black swan event, that's totally different. So that's what happened in 2020, right? The Fed cut rates following a black swan event. They cut rates following the black swan event. You had, the pandemic hit, crushed all of growth, oil went negative, all the economies and the whole global economy went to, went to nothing. So then they cut rates then. That's why the stock market dropped. It didn't drop because of the Fed cuts, right? It did not drop because of that. So now that, now that China is starting to stimulate, I also want to turn my eye over to what we're seeing with Bitcoin, right? This is new. We haven't seen this actually happen when it comes to Bitcoin. So, and not crypto in general, just mostly Bitcoin. But check out this chart. This is basically, Bitcoin. Oh, and I got to take myself off so we can see the whole chart here. So this is the longest bear market for Bitcoin that we've seen, right? If there isn't a buying signal or a bullish signal, BlackRock's coming into the market, right? Eventually, whether it's this year or next year, all the pressure goes higher. The path of pain is higher for crypto, especially for Bitcoin. So this is the longest that we've actually had a bear market for the crypto market. This is, well, Bitcoin. You just speak of Bitcoin here. This is the longest bear market. So around the corner, we're getting closer to that big upside move. Now it's probably going to come with global liquidity turning up, which we're not getting it turn up. We're not getting global liquidity turn up at a fast pace, but we're struggling here, but it is going to turn up, and that's probably going to coincide with the dollar actually rolling over. So keep your eye on the dollar here. Bitcoin in the longest bear market that it's had for a while, right? So those are pretty much the risks. Tomorrow we got to see, we want to see jobless claims, and I'm going to dip in here to the S&P intraday price action. It looks like we're pretty strong here coming off, and then we're going to look at Tesla also. But yeah, tomorrow's going to be big job. If job openings come in lower than expected, then I'm expecting the market to bounce, because that's going to signal one more variable towards a pause, right? Towards a Fed pause. And right now we can look, the market is pricing it, and this is coming down. The market is pricing in a 78% chance, 78.5. Let's see if that changed. Okay, 78.5% chance that the Fed does pause. That's what the market's pricing in. As this falls, the market's pricing in a hike, and price action should actually be flat or negative if this falls, because another hike obviously is going to create more stress and lower valuations, right? The bond market goes up. So right now the S&P is holding on that regardless. We're holding, following Jackson Hole, we're holding the high. So this is extremely bullish in the short term, right? Now if you're a short-term trader, you know that 441 was the resistance on Friday. Okay, 441 was your resistance, and the market is currently holding that resistance. We're holding the highs from the last trading day, right? S&P, this is the second support that we've actually got there at the highs. Oh, I don't like that. I don't want to see that. Let's go yellow, and let's go a little thinner. Why is this so thick? Oh, it's because it's a highlighter. Okay, here we go. So yeah, we have a couple supports here, right? At 441. That's our new short-term support, 441. And this is just micro data. This is mostly price action, right? We're resisting against 444. That's our current resistance. And that was what, Thursday? That was Wednesday's highs. On Wednesday's highs, we're finding resistance against Wednesday's highs, and then we're holding Friday's highs. So, I mean, the market is, why is it staying up here? Why are we still holding on? Why am I still bullish? Why am I still bullish here? Because China, right? China falling apart, or Chinese weakness, just leads to more stimulus, leads to more global liquidity picking up to some degree. It may strengthen the dollar, which would be, not good for risk assets, but it might be a good strengthening of the dollar, right? It might be that more liquidity is coming in, not interest rate risk. What you want is other currencies to debase against the dollar. What you don't want is interest rates to climb higher, and that's the reason for the dollar going up, right? That's what you want. So now that a quarter of and this could be the reason why the dollar keeps climbing, because a quarter of central banks are cutting rates, which means they're weakening their currencies against the dollar. as they weaken their currencies against the dollar is either going to stay flat or rise a little bit, right? But that's not necessarily negative because it increases global liquidity, right? The downside is that these bond yields keep rising and interest rates make the dollar more valuable and cause more risks to bond market liquidity. That's the big risk there. So we just need yields to stay where they're at in the short term. And I'm not too, I don't think this is such a negative event because when you look at the VIX, right, go back to insurance against the equity market, it's falling, right? I think the peak was this last week? No, the peak was about 2 weeks ago. So volatility isn't on the rise. Volatility is not rising. The vol of volatility is though. So volatility is up a little bit, and I think that could just be, we're heading into another interest rate hike. The market is pricing in our volatility is on the rise because, and this is very confusing, but this is the vol of all, and let's just not think of it don't think of it as the VIX going higher. Just think of it as more participation in instruments for the VIX is going up a little bit. And I think people are just prepping for, okay, what if we get a black swan? What if we do get interest rates rise too much and something changes really quick, right? So yeah, but bond market is not. So this is probably the more important vol metric, right? This is the more important risk off metric, which is bond volatility. That is just not climbing. All right, now over to Tesla, right? Because we know if we look at the rest of the indexes, we've been marking this trend, and we do see that the Dow is holding the trend, right? So that's one. Well, you don't want to you can count that as a trend, as the start of a trend. So we got 1, 2, 3, 4. So we're supporting the trend. The Dow is at the trend. We got a retracement, right? The market is trying to price in what it's seeing going forward. As long as we see that liquidity come in, as long as interest rates peak here, as long as we get which we're not getting, the dollar rollover, we're not getting that yet, then the trend holds, right? Earnings, I don't know. Are they going to be good? Maybe retail earnings are not so good, but tech earnings could be pretty solid here. Okay, we are seeing that global GDP from the Fed now is actually revised up. Okay, we're going to turn to Tesla now right here. Give me 1 second. We're going to do a little bit of TA on Tesla intraday, see how price is holding up. Give me a couple of minutes. I'll be right back. All right, so we're back here. Okay. So looking at Tesla, I think, Tesla looks pretty prime for a breakout. Especially if we do get that global liquidity back into the market, right? Which is, well, first, we want these jobless claims. Okay, I'm sorry, jobless claims. We want job openings to fall tomorrow. We get that tomorrow morning. If those fall, if the housing price index is flat, then, the market's going to get a little more confident that the Fed doesn't hike, and you are seeing liquidity come back in from the RRP, whether it's in equities or whether it's to slow down the bond market, we don't know. We're seeing deposits, reserves actually pick up a little bit. So, that's pretty good. Now, Tesla has broken that downtrend. Okay, we've been looking at this for a while. Tesla's broken that downtrend. And it did have support off anchored VWAP, right? We got that support off the anchored VWAP. Actually, you know what? Let's go to the daily chart. Daily chart's a little more clear here. So we broke the downtrend. It did bounce off an oversold signal, okay? It is climbing higher. We did gap up this morning based off China stimulus. That's why the market gapped up, because, China is cutting rates. They're going to increase. They're going to, it's almost like releasing a little bit of pressure from interest rates. You're releasing a little bit of global pressure. The reason why this is a big deal for Tesla because Tesla's revenue, 25% of the revenue comes from China. About 25%, right? Maybe, fact check me, but about 25% comes from China. So if China keeps cutting rates and stimulating, yes, the yuan kind of falls apart, but that's why we have one of our finance ministers talking to theirs today, because they're trying to figure out, okay, a global trade agreement without giving them chips. We don't want to give them, we've made it very clear, we do not want to give them the best chips, right? We don't want them to beat us in the war of technology. Either way, if that guidance, or I'm sorry, if that stimulus starts to come in to the capital markets before the economy, then Tesla's going to benefit from that. If it doesn't, then they're going to, they're probably going to fall apart a little bit. So there is no clear path. What it is we're looking day to day and we're seeing how the market reacts. But so far, the market is reacting pretty positive to that news. Now, if we, if we come in a little closer, what we're seeing is that Tesla is trending higher against that breakout. So here's your breakout from, I believe this was this last week? No, this breakout was, I think this breakout started, it bottomed like 2 weeks ago. Okay, so this breakout did start last week. So we broke out of that, and now we're seeing, Tesla hug that trend over, I think this was Thursday and Friday, or Wednesday, Thursday. We hugged the trend. We got back above the trend, and now Tesla is trading sideways, right? I don't really care about this anchored VWAP. Let's take this anchored VWAP off. We don't need this. So we are trading sideways for Tesla, and it's trending up. So we're getting that upwards trend. This is a little more accurate. Unless we take off, let's go ahead and remove. Yeah, let's remove the pre-market. We're not day trading, so we don't really need a pre-market. This is on TradingView, by the way. All right. So yeah, Tesla's trending up. I really think this is going to be another monster run given the data for Tesla. And I think today, where do I have it? There was an upgrade today from somebody. Somebody upgraded Tesla, citing full FSD coming online pretty soon. And Elon is live streaming FSD in California, and I don't know. I just think that sentiment itself is going to contribute to a very big upside or downside move. I'm guessing the move is going to be more upside, especially if the market recovers, and you're already down 29% on Tesla. So Tesla's still grinding higher. It is now trending outside of the downtrend from the big pullback, right? So I would say we need to hold above 240 for that continuation to happen. And usually when you do get that big pullback on the daily chart, right, oversold, then Tesla does grind higher. You need a real bad catalyst. In Evergrande, or the real estate market over in China falling apart, should be a bad catalyst, but it's not really, it's not the biggest catalyst because they're responding with more stimulus. So that's just not the case. Right? So back to other markets, let's take a look at who's moving today. And today's sort of a rest day for the market. The market is more so, the real data comes tomorrow, right? Jobless claims, Case-Shiller home price index. Home prices basically is what we got to get tomorrow. Our home price is still climbing. Are they stalled a little bit? And so the market is waiting for that. You get a nice equal weight bounce there on equal weight. Okay. Let's see, XLF. So how is banking looking? Banking starting to make sure this is on a log. Yep, we're on a log chart. So the banking sector starting to bounce here. And, we've been saying this. This might just be a trend, a grind higher on the trends. So we're seeing that. What about KRE? KRE is a big signal it did roll over from the trend. So we'll see if that continues. But KRE, or the regional banks, are going to be the most sensitive to these higher bond yields or to higher rates. So far, they're recovering after Jackson Hole. So the market's digesting Jackson Hole as a positive. And we did talk about this in the newsletter because Tom Lee cited that Jackson Hole, stocks typically recover after Jackson Hole. 6 out of 7 times going back to 1950, stocks actually go up after Jackson Hole. Okay. Kind of look like a bear flag on Tesla. Yeah, it could be. I mean, bear flag. You could say, and really, you want to zoom out. So if we zoom out, right, it's a trend higher. So if we zoom out, Tesla's trending higher, right? We're breaking out of the downtrend. We broke here, and then now we're supporting that downtrend. If we zoom in a little more, is actually a bull flag, right? Coming off that equal weight, I'm not equal weight, coming off that anchored VWAP from the lows. It's actually a bull flag there, right? But we couldn't get above this level. So if we move this up, then you get the bear flag. Yeah, I do see the bear flag, right? If we move this up, then it's sort of a bear flag for Tesla. And we are looking at some technicals. If you guys want me to do some more technicals, let me know. So yes, but you could either say this is a bear flag or it's just grinding higher out of the downtrend. If we were at the highs, Bukowski, if we were at the highs and then showing this pattern, I would say it's a little more eligible for a bear flag. But the fact that we're coming off the lows, I wouldn't say that is actually. Let me see. Okay, do you want this today? You want to do this today, Anify? So it is grinding off the low, so I don't really see that too negative, right? And this is going to come down to the S&P. This is going to come down to S&P. This is going to come down to the Qs. Can they stay bullish? That's the real question. Can they remain higher? And the downside is, again, if yields keep climbing, maybe not. But we're going to look at the jobs tomorrow. What are jobs? How did jobs go? What is the good news and what is the bad news from the economic data that the Fed did cite that they're going to be looking at going forward for the September rate hike, right? The September hike or the September decision is on the 20th of September. So you still have pretty much 3 weeks before they hike. And the market's going to be trying to price that in. The market's going to be trying to figure out whether the Fed can pause or not. And, people are still under position. There's still a lot of bears in the market. So I think we either grind sideways or we grind up a little bit given the technicals, right? So what is the Fed looking at? Well, one of the most important things, and this was just in the newsletter, is the labor market rebalancing. And right now, the average hourly earnings versus this is not average hourly earnings. This is the employee cost index versus the labor force participation rate. The labor force is climbing. Okay, so people are coming into the workforce. That's a positive. That's what they want to see versus the supply the supply we looked at earlier. The supply is job openings, which we get tomorrow. If the supply comes down and people are coming into the labor force, there is no sign of a wage price spiral. Okay, and the red is employment cost index that peaked in, I think, April, February, something like that. So the cost to the cost for employment is coming down also. That's what the Fed wants to see. So I think it's a good setup. The biggest negative that we are seeing though is home prices are still climbing, even though K Schiller, inflation, or even though we're seeing disinflation, the actual home prices are climbing. What's going on here? Here we go. And this is it right here. Single family home price index going up a little bit. It's been going up since February. So that's the negative. We get those numbers tomorrow also. Hopefully it flattens out. And these are very laggy numbers. They're lagging the most, okay? This is the level of restriction on the Fed. So the level of restriction is at 2%. This is the highest it's been for 13 years, about 13 years. So we're at a high level of restriction. The negative is, the Fed is saying, we don't know if this is high enough. We don't know if this is enough restriction because non-housing services are still pretty hot. As a matter of fact, financial services actually went up over the last 3 months. Okay. So, and that could just because the dollar is yielding more, and maybe they're actually charging people more for portfolio management because of that. I don't know. U.S. non-farm payrolls. This is another one. This needs to keep falling, so they don't want the jobs to be higher. And we get payrolls this Friday, so this is the other big data point. I'm just not talking about this yet because let's go one at a time, right? Let's price in. Let's see how the market reacts to each data point at a time, which is job openings tomorrow. And then home price index tomorrow, and then we'll go from there. QT keeps tightening. But this cash leaving the market actually today is showing that it's going back up. So that's a positive. Okay, durable goods, goods orders or PCE goods are down, and we get PCE on Friday also. Rent CPI is still is starting to roll over finally, and we know that's lagging. The Fed actually admitted, hey, this is a lagging indicator. We know it'll price in lower over the next 12 months. So CPI should be coming down for rents over the next 12 months, which is the biggest part of CPI, right? Is the rent data. So the rent data is coming in lower. We got to wait for it to actually come in. And whose method, which part of PCE, this is what the Fed actually is going to be looking at. Which part of inflation has actually met their target? Goods, durable goods, non-durable goods. Healthcare is close. Okay, healthcare is close. And we need more progress. We're not there, which is why I think they just hold in September, given the data that we're seeing right now. I think they just hold in September. So yeah, Tesla's gonna, all this data, this is a macro market right now. It's all about the macro. It's not necessarily about valuations so much. Earnings have been negative, right? Earnings are negative year over year, but they're coming out of that negative territory. And when everything's about macro, you want to look at the data and then who are the strongest companies. Tesla still has a lot of strong fundamentals, right? They're the fastest growing car in the world, the Model Y. And they're fastest growing revenue out of all automakers. Their margins are poor right now, but they're still better than other car companies. And they push those margins down on purpose to gain market share, to increase their revenue. Okay, so that's the outlook on Tesla right now. Let's see, what else do we got? So we were going to look at some of the sectors within the S&P to see who's actually up today, who's actually doing well versus the China weakness. So Chinese, I don't want to say Chinese weakness, but the Chinese scare, right? Who's actually up? There's no real macroeconomic data today. It is literally just China's going to start stimulating. The market is now anticipating China bringing stimulus online. And we've been talking about this for a while. They're going to have to stimulate because they have zero inflation, okay? So financials today, how did financials do? Let's go down the line. They're green. Who's red? That's what we're looking for. Energy positive. This is what? Oil and gas products negative today. Ooh, solar is not looking good. Solar energy is just not looking good. Probably not a whole lot of investment there. It looks like it could bounce here though, right? The RSI is showing a rebound. Just doesn't look good over the long haul. Clean energy actually looks like it's rebounding. There's some support there. These are indexes. These are the ETFs. Technology, SMH. There's a lot of people warning that SMH will go lower, and this is kind of taking a look at NVIDIA. Really, this is dragged by NVIDIA. We got the double top for SMH here. So you had a double top. That's pretty bearish price action, but it's all relative. It's all relative to the macro at the end of the day. We saw NVIDIA had probably one of the best earnings reports of all time. And the market sold off. It went up initially and sold off because it doesn't matter how great your earnings are if the macro is the real risk, which is why, we're looking at what is China going to do. They should be stimulating further, increasing capital market. And remember, when Evergrande collapsed, when it came on the actual trading exchange and it collapsed, China responded real quick. They cut the trading tax, and then they cut how hard it is to get a mortgage. So they're going to keep doing that. And the actual index in China went higher, and then US futures went higher. Okay. So I think that's going to keep happening, even though it's like, oh my God, what's the risk? Well, as long as those risks are not surprises and they keep getting taken care of, I think the market's going to be okay. Okay, communications up a little bit, industrials up a little bit, healthcare down. I thought healthcare would be going up by now. Biotech is down. Consumer discretionary, consumer staples, retail may be bouncing a little bit here. I think a lot of people are going to stay away from this because the word on the street right now is that retail is, I'm going to get to your comment, I just saw Bukowski, is that low-end consumers are starting to weaken, okay? That's not necessarily a bad thing because if they do weaken, that means spending comes down, right? So your inflation risks come down. What are your thoughts on ROI? I'll get to that too also. Real estate's actually up today. Make sure I didn't miss anything. Hey, thanks, big man, coming. I appreciate the support there, man. Should we do it this late? I guess we could do it this late. I'll just accept it. Okay, we'll do it. All right. So we'll get to that. Anyways, the retailers are signaling weakness, but that's not either a bad thing, because what it does is it means the Fed, it pushes more variables towards the Fed pause, right? So good news is bad news in a sense, right? Depending on how bad it is, good news is bad news. You want a mild economy. You don't want a hyper strong economy. You want a mild economy at this point, so that policy can actually stimulate the market. If you're bullish, if you're bearish, you want the worst case scenario. You want bond yields to go up, right? You want the dollar to break out. You want consumers to collapse. And then, there's a lot of other things you want. So it depends how you're positioned. I'm speaking for the bulls here. I'm speaking for the market going higher, because on average it goes higher. So Bukowski, let me hit you first. You said, what do you think about, here we go. What do you think about Chinese stock market going forward? Read that they are going to stimulate buying of the stock market. Well, they did cut that stamp tax. They're going to try to increase, incentive for people to, let's see what Alibaba did today. They're going to try to increase. Yeah, Alibaba jumped, right? It gapped up. China, I just expect this. China will keep stimulating. Am I interested in China as a play? Let me leave that up there. Sorry. No, I am not, because China is just the first signal before the global economy starts to turn and ease. Okay. It's just the first signal. I don't trust Chinese stocks. I'd rather be in Tesla, or Apple or Amazon. I don't know if Amazon has exposure, but I'd rather be in Tesla because they're exposed to the Chinese economy, right? So there's way more demand for, I'd rather be in Tesla, because if the Chinese economy expands, there goes more Tesla demand at the same time, right? Yeah, they're gonna keep cutting rates. They're gonna keep stimulating their markets to some degree. They have no choice. They really have no choice but to do it. When economies weaken, right? When economies weaken, you get more stimulus in some way or another. Seed Rahami, what up? What are your thoughts on RIO real estate, crypto? Realio crypto? I don't even know what this is. RIO? I've never heard of this, to be honest with you. I could give you the technicals. Looks like it's trending lower, maybe in a big wedge. I don't know the fundamentals of this, so I really can't tell you. I can jump over, I can try to see what this is. If the ticker is RIO, or if it's a crypto, so USD, then I really don't know what it is, but let's see what Rio is. Rio Tinto Mining Metals Group. I don't know. This is a big company, actually. 103 billion. This is a big company right here, Rio. I don't know if that's what you're talking about. If you're talking about a crypto, on the other hand, then I would be cautious at this point. I think the bull market is around the corner. Like we just saw, this is the longest bear market for Bitcoin in history. Let's try Rio USD. Longest bear market in history. I don't know. I don't see it. Rio Tether USDT. Okay, there it is. Realio. I don't have thoughts on this crypto. I don't have thoughts on this crypto. On a technical basis, you got support at 18 cents. Yeah, you got support at 18 cents, 19 cents, but I don't know if it has any real, stopping power. Like, let's say there is some big risk that hit the market. These things can tank 80%. That's why, where Bitcoin might fall another 10, maybe 15, these will tank 80%. On the upside, you just wait for Bitcoin to get back into the bull market, and then a lot of these coins will just keep running. The altcoins are going higher eventually. So, I would just stick in altcoins that have a real strong thesis, right, for the global financial system, not just for, not just shilling their coins. So that's what I would say on that. I don't really know about it. Do you think about buying any crypto when government wants to keep the dollar strong? The government wants to keep the dollar strong, but sideways, not necessarily super strong. They just want the dollar to stay in range. So if we go to the dollar and we look at it, what the dollar kind of looks like over time, It is actually breaking out on a super. If you look at the, if you look at the overall dollar, right? If you look at the dollar on a big long-term basis, it actually is breaking out, right? But every time the dollar goes too high, there's some type of geopolitical intervention where another country, well, a bunch of countries, that's why you have the, BRICS coming out. Basically, they're saying, hey, you're hurting global trade. The higher the dollar goes, the more expensive it is to trade, right? I call it the cost of trade. The dollar is the cost of trade. So if trade goes higher, it hurts other countries. So what the US does is they make deals. Okay, well, you invest in the US and we're going to print more dollars, or we're going to extend our swap lines to other central banks to give them more access to dollars. So the dollar is breaking out over long term, but this is, the dollar is more of a, I wouldn't call, it's not like an asset that moves from investors. It's more so a geopolitical, it depends on the macro. So I think the dollar goes lower from here and then goes up again because of global debt is denominated in dollars. So eventually, I don't know what's going to happen. It's a big deal. Either way, do I think crypto goes higher? Yes, I do. I would still, oh, that's Prakash. What up, Prakash? I would still get long crypto because the dollar, the dollar is one thing. Crypto's a technology more than a currency. It's a technology. So you want to look at it in terms of technology. What does Bitcoin do? It gives you a store of value against other currencies. It's a savings account. It's not a currency to actually, it's not going to be a currency for a while. If it ever is, it is a savings account. It is a monster savings account that can't be debased. And, it's going to get exposure to BlackRock and the the U.S. financial retirement system. That's what the exposure is going to come from. It's a store of value, right? It's not a currency yet. So I don't think the dollar really competes with Bitcoin. I think the Bitcoin competes more so with U.S. Treasury bonds as a store of value, and equities, real estate. It competes with store of value assets, which isn't the dollar. Nobody stores value in the dollar because it gets debased and loses its value and purchasing power over time. So that's what I'd say about that when it comes to the dollar. What's up? What up, Watermelon? How you guys doing? Hey, don't forget to hit me up go follow me on YouTube. I just asked you guys to help me out on YouTube, trying to grow the channel there, right? So if you guys don't mind, jump over to YouTube. I'd appreciate it. Let me know who you are. Just hit the comments. A comment will stick in there. And I'm really trying to grow on YouTube, trying to get things going here. All right. So if you guys have questions, let me know. I think I can answer just about any macro question that has to do with the stock market or crypto going higher or lower. I'm more of a technician, right? Not like, oh, let's just talk about oil in the 10 years from now. Well, I'm going to tell you how the market will respond to that. Oil getting, rejected here is a big deal. Global commodities are actually falling, and that's very bullish for the market. Mila, what up? Sandoval, how you doing? Willie Bankia in the chocolate factory. Bankia, okay. Willie Bankia in the chocolate factory. All right. When do you go live on YouTube? I'm trying to get my schedule together right now. It's kind of all over the place, but I'm gonna say 11. Oh, well, I guess when it comes to Eastern time, what I'm trying to do is go live on YouTube, and I'll post it on my channel. I'm refreshing some of how it looks, but trying to get a new schedule. But I think I'll be live on YouTube for this week at least. My schedule will be, let's see, I have to think in terms of Eastern time. I'll be live at 11:45 Eastern. I'm sorry, I think I'm Mountain Standard or Pacific time. So 12, 1, 2. So about 2:45 Eastern time. 2:45 Eastern time, possibly 3. Basically going into power hour, right? We're looking at power hour. I'm not trading, so we're looking at, how's the market pricing things in, going into the close, basically covering all the data. I'm trying new things out. I'm experimenting here on how to do my content. But look at S&P. Look, going into power hour, S&P is holding, it's consolidating at a higher low, right? And I'll tell you exactly why I think it is. So yeah, that's what I'm looking at right now. Oh, live on YouTube. Yes, I'm live on YouTube right now. So if you guys don't mind jumping on, some of you guys probably did. Thanks for jumping on there. I appreciate you guys. Let me know who you are. The more familiar I get with you, the more, it's easier to answer your questions. And when we do some stuff in the future for the community, then I will remember you for the most part, right? Unless I, break my mind, unless I get in a wreck and forget everything. Anyways, some comments were filtered. Yeah, and hey, if there's any bears on here, let me know. If you guys think I'm full of crap or something is, off, let me know. But I do like to just break down. Look, global liquidity is now, it's now, well, today, right? The last 2 days after Jackson Hole. This is really key here. After Jackson Hole, after the big Fed meeting, right, which is basically, dang, spies at 443. After the big Fed meeting, you're really getting the signal for what, ooh, that was a big move. So S&P is on the run here. I think we might be seeing FOMO. We still need to get above 444, but we could be getting FOMO here because Jackson Hole, after that meeting, what I saw, what I heard from all the Fed members who spoke was we should pause. We should pause and wait. None of them communicated that we should keep hiking unless we're data dependent is what they said. And we are looking at the data. What is the data that they want to see first? And we'll go through this today. Here's the data they want to see. Tuesday. No, this is August. Yeah. So Tuesday, tomorrow. There's no data today, right? Tuesday, tomorrow. Home prices, not the indexes. The indexes are coming down. Home prices, right? They're going higher. But this is a backwards looking data. So April, May, June, right? We're going to get April, May, June's data, which is very laggy. So we're looking at lagging data here. So if we go back to June on the home price index, June was still falling, right? And then if we go to Case-Shiller, and what I'm pointing out here is that we might actually get a deceleration. If you go to Case-Shiller, it's actually negative. So maybe prices will be flat. That'll be a big deal. The market is expecting 406.5, right? We're at 404. The market is expecting 406. Anything below 406, here's consensus change. It's at 404. Anything below 404 is going to be really bullish for the market. It doesn't mean it goes bullish right away. It just means the market's like, okay, that's not reason for for Powell to hike. Okay. Then you got job openings. Is labor supply coming down? Not supply of people, supply of jobs, right? Potential labor job openings. You want those lower. So that's our big data for tomorrow. There's other stuff on there, but it's not as important. We know the manufacturing economy is in a recession going forward after that. Right. And I'm looking at the global economy also. I'm looking at inflation rates from other countries and they're coming down. That means they can stimulate going forward, which is why we do see the 25% of central banks starting to cut rates actually. So inflation rate for Germany, who is the fourth biggest economy, I believe it's US, China, Japan, and it's arguably between the UK, Germany, and India. India is growing really fast here. ADP payrolls. So we're going to look at the payrolls. Those have gotten revised down and up. So I don't know if we could even trust the jobs data right now. Either way, the market will still react. Now, looking at GDP quarter over quarter, this is the big, which one is a growth rate? GDP second, what is this? GDP index. So we're looking at the growth rate for Wednesday, I believe. And, I don't think this is going to be positive or negative. If we're stronger, if the market comes in stronger, maybe bond yields go up a little bit, but that's not not going to cause the Fed to hike rates, GDP going up. It's going to be more the labor market coming into balance and home prices not going up. All right. And then Thursday, core PC. Thursday is going to be the consumer. How does the consumer looking? If they weaken, that's reason to pause. If they strengthen, they might hike. If core PCE or the Fed's preferred inflation gauge goes up, right, and it's expected to go up at 3.3%, then, it's expected to go up. So, no, consensus is flat. My bad. Consensus is actually flat. Am I reading this right here? No, it's set to go up. Okay, so it's set to go up. So if it does go up, which it probably will because this is a lagging indicator also from inflation, then that's not a good outlook for the Fed. We'll see. We'll see how the market. There's a lot of data. We're gonna go day by day though, right? You can't memorize all this data at once. Let's go day by day and see how the market reacts. All right, so big rejection there by SPY actually into that resistance level at 444. Got a big rejection there. See what else are we missing here? But the good news is global 10-year bond yields eased a bit today. And that's really causing the havoc in the market. When they ease, the dollar eases, and then you get a bid back into risk assets in general, right? And I did want to talk about Bitcoin too. Do you think July GDP data will increase, crypto fam? July GDP data. Let's see. Good question there. Good question. Let's see what the numbers. Let me check the numbers really quick. So July GDP, and we have two. We have the price index, which you don't want to look at. So never look at the price index for GDP. You're looking at the growth rate, right? The growth rate right now is at 2.4. Well, the Atlanta Fed GDP has it going up. So yes, I think so. I think GDP is rebounding, not because of the consumer, most consumers, because of a lot of interest income. So think of it this way. Yes, I do think it goes up. The expectation is 2.4%, which would be higher than 2%. These are all estimates here. So the consensus is 2.4%. We either come in there or higher because there's still a lot of spending happening in the economy, right? It is probably going to slow down a little bit in the back half of the year, but people are earning cash, and these are more higher income individuals. They're earning cash, right? They're earning on their cash, parking it at money market funds, and they're stimulating, or their dividend interest income, they're stimulating, right? Or their treasury bonds, they're getting paid on that. So they're still spending in the economy, especially the baby boomers who are retiring. They're still spending in the economy to enjoy services, which is why services are, actually holding up the economy here, not really goods. They're not buying houses. Nobody's going to buy houses, which is why I think growth isn't going to explode here. Is going to be negative for the Fed. You want growth to go up. You just don't want it to, you want more labor to come in as that happens. So maybe AI does make a difference here. Maybe AI can lower the wage inflation or keep the labor market more in balance for the Fed. So I think GDP does go up or stays flat going into Wednesday and Thursday. Ava Mystery, what up? Hey, thanks for you guys jumping on the YouTube. I appreciate you guys jumping on there. Go subscribe. Help me out with the algorithm. Trying to grow on there. Oh, Chavez, I didn't even see that. You said 20% chance of raising rates. Well, there's actually, if we go to the actual Fed, CME Fed watch, like none of us really know. This is just the best way of actually looking at it. There's a 21.5% chance that the Fed does raise rates, which is why we're looking at the day-to-day data, or the data a day ahead. We're going to look a day ahead at the date. So tomorrow we are going to report on job openings, right? We're going to see, what are estimates, how did the data actually come in, and find out whether, those jobs are falling, the job openings are falling or not. And then we'll keep our eye on China at night. I'll keep my eye on China to see, dang, Twitter is slow, to see if China's going to keep stimulating. I think they do. I think China does keep stimulating. Let's see, are we missing anything here? But remember, the Fed funds rate is in very restrictive territory. It's in very restrictive territory. So I'm optimistic about that. Meaning they don't have a reason. They have more reasons to pause here. There's a lot more reasons to pause here if you're a bull, right? A lot more reasons to pause. Jumping over, how you guys doing? What up? Sky Rye, Ava. So jumping over to Bitcoin, I know a lot of people are in crypto. They're worried right now, but the fear and greed index, watch fear and greed. Let's see if I can find it on Twitter. Usually Twitter has everything. You just put in here, crypto fear greed index, right? Let's see where it's at. I think it's leaning more towards fear. Yep. Well, this is Ethereum, but it's starting to lean more fearful. That's usually a very good sign that people are going to stop selling, and they're going to start panicking. It's really it's kind of inverse to how you think. But the more fear, the more chances that it stops going down. Unless you get some type of event. If you get an event, well, that changes the actual scenario. But technically, going to the daily chart, right, on a technical basis, you have this very oversold RSI, right? So Ethereum at least got to an oversold of 20, which was where it dropped in June when it dropped to 800. And ETH had a gigantic drop. I mean, it went from the highs, we're talking 81% and 81.5% drop for ETH. So we just got that same type of selling pressure, but now we're holding at 1600. We're holding at double the price, right? And it went from that drop, it went from 800 to, it went to what, 2000? So it doubled, a little more than doubled. So if we double from here, right, from those lows, we're talking maybe 3,000, right, over the next couple months. Now, does that mean we're just going to go up because of price? No, we need the macro to improve. We need the Fed to pause. We need China to keep stimulating. We need better regulation. We need the Bitcoin ETF to come online, the Ethereum ETFs that are waiting, right? You need bond yields to ease off, and you need risk to come back into the market, right? So there's a lot of reasons, but the price action tells me that we're pretty much overblown, that the lows are pretty much in for crypto, given that everything stays equal, right? Given that everything stays equal there. So yeah, I think that's mostly what we're seeing here. I think that is what we're seeing here. And I think the biggest upside here is that, at least in the short term, the last couple of days, was this Friday, Thursday. Yeah, this thing is tracking on a daily basis, which is the RRP liquidity. I think I can actually pull it up on the charts. See, let's go pull it up at the charts. Fed liquidity. Okay, yeah, it's been moving higher. I'm gonna turn this blue. Yeah, so I'm keeping my eye on this Fed liquidity. Yeah, any other questions that we got here going forward? Any other questions? I'm gonna just go over some technicals, right? And then we're gonna end the video. Usually they do about 90 minutes till what market should be closing anyway. We'll do about 30. We usually do, yeah, about 20 more minutes. We've been on for an hour, 10 minutes. All right. So let's look at these technicals for tech. Okay. Let's do some technicals really quick. This is the funnest part for me, to look at the technicals here. All right. So here we got the Qs. All right. Qs finding resistance at 373, right? That's the tech sector. Finding resistance at 373, that's the ETF. But we're holding, as you can see, we are holding the uptrend. So I pointed this out this weekend. The market is still on its uptrend path. We're still in the bull market trend. And at the same time, you're getting an alignment of oversold RSI starting to bounce. So the pressure is back to the upside. What keeps us there? More reasons for the Fed to pause. Not to cut, but more reasons for the Fed to pause. And I think we are getting more reasons for the Fed to pause because rent inflation is coming down, jobs are coming into balance, and consumers are slowing down a little bit, right? So it's really the bond market that's putting pressure here. Going over to the SPY, same thing, right? We are getting that. We got that bounce, that hammer candle on the SPY off of 438, and we're finding resistance at 444. We could gap up tomorrow, or not. Where if we get above 444. Then you're getting more confidence coming in. Another thing to remember here when it comes to the S&P 500, any Tom Lee news yet? The Tom Lee, the last Tom Lee news, Bukowski was that not any Tom Lee news lately, but the last news he said is that typically the markets, I like to do his voice. He said basically typically the markets go higher after the Jackson Hole meeting, and we're literally seeing that. If today closes green, we're getting 2 days in a row of green candles, right? Two days in a row. That's important. We got that from the lows here, back in it's not like weeks ago, or it's not months ago, but we got that in early August, and then today will be a second close 2 days in a row, right? 2 consecutive days of closing green. That'll be positive, right? We got to eat up this big candle, that 444 that we gapped down on before Jackson Hole. So I think we're still optimistic, but it does depend on the data. Okay, IWM, right? Small caps. Small caps are still trending up. There's pretty much a reverse head and shoulders on a lot of indexes. They all look kind of similar, but they're still trending up. Even if they break down, they probably just bounce on the trend. Dow, right on the trend, right? Dow has trend support. ARK, right at the trend. Wow, how perfect is that? ARK came right into the dang uptrend, right? Right into the uptrend, holding $40, and we'll see if it continues from there. Apple, hey, Apple's also positive, holding. This is not all-time highs. This is the previous support for Apple at 175. Needs to get above 183-ish to confirm the uptrend. But Apple is, I like to call it an echo chamber or a bellwether for the rest of the market. If the biggest stock in the market is showing resilience, well, that's really good breath for the market. And I know people measure breath as in you need all the market going higher. But whenever Apple chugs higher and people shave a little bit off, they're going to rotate that into other equity markets. When Apple sinks, well, I mean, that's probably a red flag, right? That's probably the safest risk off stock in the market is Apple. They don't really have a lot of risk to Apple other than China. Amazon. Amazon is finding resistance against 137. I don't know the details of Amazon. They should be moving higher. I don't know. I don't know Amazon too well as far as what's going on fundamentally. I'm more focused on what's happening with Tesla. Okay. Google. Google's still trending higher, right? Google's on the uptrend. Still looks pretty solid here. Yeah, Google looks good. It's still it's still on the uptrend, so that's good. Meta. Meta always has funky price action. Meta broke their downtrend, but finding support at 275. Okay, so you got support for Meta at 275. Should be going higher from there. Microsoft, another bellwether stock in my view, especially for tech. Looks kind of nasty. Actually, does look kind of nasty. This is, what are we seeing? This is just gross price action. There's nothing to see here. There's nothing to see here. Looks like a reverse head and shoulders. Okay, if you drop below 315, might be in trouble. But not really good price action there for Microsoft. Netflix, another reverse head and shoulders. These all, I mean, not reverse, a lot of head and shoulders here that we're seeing here. This is the head and shoulders, right? They all kind of look like this, except for who? Who doesn't look like this? Tesla. Tesla, there's no head and shoulders for Tesla. And now some people will try to say, oh, here's the shoulder, here's the head, here's the shoulder. I get it. But it's not a clean head and shoulders. It's more of an upside trend. Okay. NVIDIA, another bellwether stock here. NVIDIA caught a bid today. Now this is actually really good for market price action. The fact that NVIDIA bounced and they had insane growth. They had some insane growth there. AMD, AMD is in a gigantic falling flag pattern. I mean, when it breaks out, it's gonna go. It's gonna go, but this all depends on the macro. Okay, who else we got? Zoom. Hey, Zoom had a really good earnings report, but it just can't catch a bid here. And I think a lot of it is, I think it was like global. There's not a whole lot of people, what do you call it? Refining their, I call it refinancing, but basically they don't have a whole lot of corporations buying back. They're competing with Google and Microsoft. Right? I believe it's Microsoft and Google. Maybe I'm wrong, but mostly Microsoft Teams. And we'll see how that plays out. But I think it's more of a risk asset, and it should have some room to go. Teladoc's not doing too good. TSM, man, Teladoc made a new low. Not good. I'm still holding a contract there. We'll see how it does. It's really far out though. Square struggling a bit. SoFi, Roku had a nice move. Roku's trending higher. Okay, so Roku's still trending higher. Palantir, holding that $14 level still. Okay. Oh yeah. So what do I think? Bukowski says, what do I think about going into September? Isn't that historically a bad month for stock market? Yes, it is. Yes, September is typically the worst month for stocks. But it really, it's not always the worst week. It's usually the worst week. And usually October is the bear market killers, right? If we go back, the market bottom in October. So that could be the case. But I think everybody's looking at that seasonality. They call it the seasonal weakness. And when everybody sees it and everybody's focused on the seasonal weakness, usually not usually, but I think you're going to get a bouncer. I think we're going to bottom before that because we have a CPI report September 11th or somewhere mid-September, and then you have the Fed rate decision. Maybe they pause, maybe they don't, and then so yeah, maybe the market does sell off, and then we bottom in October. But yeah, we're in seasonal weakness. So that's, I mean, it's a given. If you keep going higher all year, it's not really healthy. So I think this is good. This is really good seasonal weakness for the market. Open door came back down. Support at what, 330, 320? ENPH still falling. Wow. Now that is going to be one big upside move. Probably a lot of shorts in there. It's going to be a crazy call option when it does start to launch. PayPal. Okay, yeah, PayPal too. PayPal got rejected. Okay. So yeah, that's what it's looking like. I don't know. We'll see how the market does though going forward. I'm gonna look at some of these intraday. Let me see. Let me pull up this chart. Pull up some other charts here. Yep, historically bad month for the stock market. All right, let's see how this one looks. So the market did just close. And if you're just joining, you can rewatch all the content on YouTube. It'll be on YouTube, link in the bio. From the very beginning, we went over the macro data, China, what's going on with China, and how that plays out with the macro, right? So we're going over China. The data for tomorrow, that's important. What data do we want to see tomorrow that's going to lean the Fed towards hiking or towards pausing here? And the market's going to be concerned about that. So yeah, this is Tesla. Tesla ended up holding the lows. That's also good, 236. But looking at SPY and the Qs, right? Nice little wedge. Oh, I didn't realize that was a gap. We filled the gap. Okay. So S&P filled the gap from what? From Thursday? We filled the gap from Thursday here at 443. Did not realize that. Just saw that. So the S&P just filled the gap 3 times. No gap and go. No gap and go, but pretty strong price action coming off Jackson Hole. Pretty strong price action coming off Jackson Hole. So that's the optimism. And we're holding the highs from Friday, from Jackson Hole. Yeah, there's some buyers here. There's some buyers in this market for sure. Let's go to the 5-minute chart here. All right, so now to the equal weight. Let's look a little bit on breadth, and that's what I wanted to peek out. I think breadth is going to bottom here. Okay, so when I talk about breadth, I'm speaking of how many stocks are moving above the 50-day moving average. Looks like we bottomed here at about 27 stocks. I'm sorry, not stocks. 27% of S&P 500 companies bottoming are below the 50-day moving average. Extremely oversold there, so we could be pushing up here. Now let's go to the 100. How many stocks above the 100 we bottomed out at? 45% of stocks trading below the 100 daily moving average. Hopefully this is the bottom for market breadth. And then about 50% for the 200 daily moving average. So that's not bad, right? So 50% of S&P 500 companies are still trading above their 200. We want to see this expand. We want to see these charts start to expand to the upside, and that means the breadth is back. That means we're getting breadth come back into the market. This is also, if you have TOS, NDXE is equal weight for the Qs. And do I have that on here? NDXE? Right? Because I know people focus on the Magnificent Seven, Apple, Amazon, Google, Microsoft, Tesla, NVIDIA, but if you want to look at the equal weighted average, that's going to give you more of how the basket is working. Oh, I do have it on here. Yeah, there it is. That just double bottomed. We got a double bottom on that. No head and shoulders. The head and shoulders didn't follow through. So you're getting, you're starting to see a bottoming happen here in the market going forward. The buyers are still here. They need more negative evidence to actually roll over. Yep, still in the bull market. Quarterly moving averages. Okay, so looking at the last quarter of earnings on a technical basis, oh, we're trying to get above that last 1 quarter of earnings for SPY. SPX is, let's go to SPX, see what that looks like. Yeah, trying to get above. I think the level's 444, right? Oh, what up, Mosine? I think the level is 444. We need the S&P to get above 444 and hold. I'm going to call that out right now. Okay, just so you guys know, to break this downtrend, let's go to the daily. It'll be easier to see in the daily chart. So to break this downtrend and to start bidding back up, we need to get and hold above 444. That's the level right now for S&P. Right, here's the downtrend. These are the quarterly moving average. Well, this is the daily. We're supposed to use it on the weekly. So actually, what is, hold on. Yeah, that's the weekly. Okay. Let's go to, I think we're moving off the 100 daily moving average also. SPY 480 end of year. Yeah, I think so too. I think the SPY goes to all-time highs. Right now, given what we're seeing, I think SPY goes to all-time highs. Mosine also. Dang, I have a lot of stuff marked up here. Let's remove some of this. Yeah, 444. So 444 is also going to be the 50-day moving average. That's our key level right now. 444, 444.50. I think it's really, yeah, 444 to 444.50 is our key level for the S&P. That's what we need to hold. Can I duplicate this? Yep. And then let's move it up. There we go. All right. So that's the level that the S&P needs to hold. We're coming right back into that first resistance level. The break of the downtrend is almost near too. Starting to break that downtrend. Let's actually make this a solid line. See what it looks like. There we go. So that's what we're looking at for S&P. We're pushing the downtrend. We're breaking the downtrend. We got down to S3, so support level 3. This was S1, S2. We got down to S3, found support, got above S2. Now we're holding it. Jackson Hole's already over. Got past the symposium, and now we're testing the trend. We got rejected earlier. We're 2 days in a row. We're up. Last time we got 2 days in a row earlier in the week. We kept moving higher. Then we got hit on Friday. Now, I would say keep in mind here, the PCE data is not going to look that good because of oil, right? It's looking at oil from last week. So the PCE data is not going to look good. Job openings should look good. Job openings should look good. What else do we have? Home price index. I don't know. We'll see how that comes out. And then consumers are going to be weakening. So I think that's going to be a boost for the market. If consumers keep weakening because of, the summertime's over, so a lot of demand is gone. Back to school wasn't as strong as we thought either, according to some of the reports. Then bond yields should ease from there, and then we should get, you're going to start here, oh, recession, and then we should see the S&P bid higher, because as bond yields come down, valuations will increase, right? So PCE is probably our biggest issue on Friday. What else do we have? Unemployment probably remains low. Maybe it ticks up a little bit. Payrolls I expect to come down. I think there's more data in favor of a pause, and I think that's going to drive this market higher. That's all I got for you guys. I appreciate the follows and all that, If I see anything else, I'll come out with the video. We'll talk about it. But for the most part, the big news here is, other than looking at the data, China is going to have to start stimulating again. Peace out. Catch you guys later. Stay blessed. Get your workout. Stay healthy. And we'll catch you guys tomorrow. I'll be on at, 2:45 Eastern time. Okay, 2:45 Eastern time. That's the time right now. If it changes, I'll let you know. 2:45 Eastern time. Stay strong. Let me get the exit music too. Still waiting for that stream deck to be fixed. Oh, how's that? It's not bad. I changed my mind. You know what I'm going to do? This is still a live stream. I'm going to end it with what the Fed said to remind you guys what the Fed is saying. Let's do that. Right? What is the Fed saying here? I'm going to end it with that. Where is it? Okay, here we go. On YouTube anyways. I'm going to end it with what the Fed, so you guys can get that information throughout your head. Here's what the Fed's been saying, and then I'll exit right after that.
We are prepared to raise rates further if appropriate.
We are at a restrictive stance, in my view.
We're at a very restrictive stance on policy.
And intend to hold policy at a restrictive level. The process still has a long way to go.
It's not as though keeping rates where they are is doing nothing. We're actually continuing to put pressure on the economy.
On net, motor vehicle inflation has declined sharply.
How long to stay restrictive? As inflation comes down, the real interest rate,
that is the rate minus inflation.
in other words, nominal rates adjusted for inflation,
The real rate is our preferred measure.
that'll actually be tightening.
That's the way to think about how tight is the environment. And holding the rate at 5.5, 5.25, something, as inflation goes down, is implicitly tightening because the real rate will be going up.
The question is whether we need to increase the pressure or just keep pushing. And I'm in the camp right now, just keep the pressure going, let this work through. Let us work through that. Let the banking system work through it. Let the corporations work through it. I think we just keep the pressure on and see how things turn out.
We don't see any evidence that there's a wage price spiral.
We're not seeing really any evidence of wage price spiral.
That's not what we're seeing now.
Wage growth across a range of measures continues to slow.
We are seeing the labor market moderate.
Wage growth is largely what we saw in price growth from 6 months ago. They're a lagging indicator, not a leading indicator.
We have to get inflation down to 2%.
We have to get inflation back down to 2%.
2% is and will remain our inflation target.
One or two great readings on inflation aren't really enough.
Goods and housing, those are the things that got to start coming down notably.
After decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Persistently above trend growth could warrant further tightening of monetary policy.
If service inflation in particular, core service inflation, whatever you want to call it, super core, if that continues to stall, then I'd say we have to do more.
Because leases turn over slowly, it takes time for a decline in market rent growth to work its way into the overall inflation measure. If market rent growth settles near pre-pandemic levels, housing services inflation should decline toward its pre-pandemic level as well.
Mortgage rates are very high, and so many people are locked into very low mortgage loans that they don't want to move. Are we going to be waiting a generation to get the housing market going again?
When we are convinced that inflation is moving down sustainably back to 2%, we'll be able to move policy into a less restrictive stance. And as we do that, we're going to see mortgage rates come down.
People who calculate CPI suggest we're going to see it go back up.
On the headline side, yeah, for sure. We're going to see shelter inflation come down. You see this with real-time rents. If service inflation in particular, or core service inflation, whatever you want to call it, super core, if that continues to stall, then I'd say we have to do more.
Employment's still 3.5%. Growth this quarter could come in at about 3%.
Yep.
What is the evidence that we're sufficiently restrictive?
Labor markets are definitely easing up. We're hearing this over and over again. It's easier to get employees.
Rebalancing has eased wage pressures.
And the retail numbers I'm a little suspicious of, because what we're hearing, for example, from a major supplier to the back-to-school market, is sales are not what they expected. We are starting to see these early signs. I don't think we need to react either way right now. Just let this ride a little bit. Just keep putting the pressure on.
How long do you need to keep the pressure on?
Next year at the earliest.
If inflation keeps coming down, real rates continue to rise and put additional pressure on the economy, would you see the Fed recalibrate its peak rate to keep the pressure steady as opposed to letting it grow?
It's possible, right? We really need to see inflation moving down. We're seeing early signs of that. Again, I'm getting story after story from all our contacts that it is starting to happen. But I want to keep rates where they are right now, and then we'll decide later what we do. Remember, before the pandemic, we had low interest rates, low unemployment, and low inflation. I think it's plausible that we can get back to that. It is plausible. We lived in that world. We've proven that that can happen. And so could it happen again? Yes.
Sounds like a base case when I listen to you. Is that your base case?
I don't know. I mean, at this point, I'm not quite sure. But clearly, we think we'll get back to trend growth in a couple of years. We'll get inflation under control in a couple of years.
Job openings remain high but are trending lower. Payroll job growth has slowed significantly. Total hours worked has been flat over the past 6 months, and the average work week has declined to the lower end of its pre-pandemic range, reflecting a gradual